Hello and welcome to Off the Books, where we're surfing the uncharted waters of accounting, finance, risk, and wherever else the waves take us. This episode is brought to you by Workiva, the risk, reporting, compliance, and winter storm ready platform that simplifies your complex work. Check it out at workiva.com/podcast. My name is Steve Soder, accounting enthusiast, Diet Coke aficionado, and today's host, and I'm looking forward to debating a great conversation, and I'm very glad to have you hanging 10 with us. Joining us today is our co-host, Catherine Tsai. Catherine, can you please tell the fine folks at home who you are?
I'm not an accountant or Diet Coke aficionado, but I like asking questions, learning new things, and writing about it later, so I'm here to learn.
Thank you, Catherine. So you and I often talk about accounting and SEC reporting on this podcast, of course, but recently we've been talking about how much all of this stuff really matters and whether it matters at all. For example, 10-Ks are the annual financial reports that companies file with the U.S. Securities and Exchange Commission and are usually focused on pretty wonky financial reporting matters, but lately have started to include much broader messaging from CEOs. We've also been talking about how much the underlying accounting in these 10-Ks even matters, since accounting valuations seem to be very different from how the market values these organizations.
And to break it all down, we brought in podcast recidivist Nick Mazing from Centio.
You're seeing companies, and obviously it's still a kind of a small subset of companies, but you're seeing companies using the 10K filing as an opportunity to highlight their CEO letters, and it's one very high-profile example. JP Morgan has a dedicated press release saying that their CEO's letter, Jamie Dimon's letter, is it's a sizable document. Like the CEO letter itself is 66 pages, and I recommend to anybody who probably learn more from it than from your average business book. I love reading it every year. So it is something that I think is happening, and a company should probably consider, if they have that already, highlighting that as a companion document.
What's going on here with all of these CEO letters? Are people trying to become the next Warren Buffett? I mean, a 66-page letter, I don't know if I could get through it all.
Yeah, the why really is the more interesting question. So I can see a few reasons here. So number one is the 10K is probably too technical for many stakeholders, including most employees and probably most customers. A more conversational document like a letter can serve as a bridge between, to help with the understanding of the strategy, execution, competition, regulation, many other relevant factors, because it can add details that are not necessarily 10K worthy, and yet they're important. So, and a widely shared letter from a CEO, it just really serves as a great marketing for the CEO herself or himself.
A 66-page letter, again, seems so long, but maybe this is a good time to talk about technology and whether that's played a part in some of these CEO letters too, because I'm thinking of a platform like yours, Nick, Centio. If you have a 66-page letter, normally if you're reading it on your own, that takes a really long time, but if you've got like a powerful search engine, maybe it takes a little bit less time to get through.
And maybe it's an opportunity to intentionally put in, right, phrases or buzzwords or other things that are going to get picked up by that technology, right?
Natural language processing is in fact a cat and mouse game, and you see this quite a bit. You see it a lot more on the transcripts, because obviously the IR teams are very careful with what they put, especially in the prepared remarks, because they know that the robots are listening, and it is always very interesting to see how language changes. So you may see something like, "Oh, that's a great question," or something like that, which might improve sentiment scoring, as people are. It's very interesting. I think looking at what's been happening with sentiment is one of the more dynamic places. But yes, I think the CEO letters are a part of that, right? You have to market to investors, potential employees, and so on.
And it seems like, Nick, and to be clear for our audience, there are things that are, I would say, popular right now, like climate change or human capital disclosures. Those are actually mandated disclosures by the SEC and will become increasingly so. But as we've talked about, there's been some real trends, right, where you start to see certain groups of words pop up in popularity, right, and then they disappear almost as fast as they came. I mean, you and I have highlighted that a number of times, Nick.
Yeah, so 10K language trends, now that we're coming up to the close of the year, are very interesting, and you see very strong growth in almost anything related to ESG topics. For example, if you look at what would happen if you were to convert the U.S. electric grid to provide all of the requirements for transportation from hydrocarbons, the amount of copper that is required is absolutely insane, right? So obviously that is something that is material, whether you're a utility company or a copper company, right? So you really see the kind of the ripple effects of these big trends that are happening, and then sometimes you have step increases in disclosures just because of a requirement that came into place this year. So, for example, 2021, we had the enhanced human capital disclosures, right? And just for fun, I did exact match our most valuable asset, right? And it went to about 60 10Ks this year, and there was around 10 to 12 in the prior years, pretty consistently. And now, what is our most valuable asset? I'm not aware of any company that has ever said that their employees are not their most valuable asset. Our employees are our third most valuable asset or something like that. But obviously, you see those step changes that are in response to some kind of reporting requirement change. I think in general people should be, that's obviously everybody knows about it, but I think the kind of the softer, gradually growing trends are more interesting.
Nick, let's move beyond the 10K now and maybe talk about GAAP, generally accepted accounting principles. I know that you know that I'm an accounting enthusiast, so you're always very respectful about accounting and so forth, but maybe this is an opportunity for you to bust loose a little bit. The three of us were talking the other day about the astonishing difference between price and book value, in some cases as high as 5-to-1, meaning that the price the market is willing to pay for a company is 5 times higher than the accounting value on the books. I know that investors price companies differently from how accountants ascribe value, but 5-to-1 is a huge gap. And so, pardon the pun, but does this gap mean that GAAP, generally accepted accounting principles, is still stuck in its awkward teenage phase and we just can't get it out? I mean, what's the difference? What's going on here? Before Nick answers, let me clarify for our audience that when we talk about price to book, we're talking about the difference in the market price of a company as calculated by their stock price versus the book value, which is the accounting value of a company based on their financial statements. These two things actually are often different, and Nick's going to break down why.
Yeah, I mean, the average price to book for the S&P 500 is 4.8-to-1. In other words, the market is paying almost 5 times the book value of the companies, right? So that alone is telling you have some kind of a pretty major problem, right? You're reporting a number that nobody necessarily takes into consideration. You look at the largest market capitalization companies. You have Apple is at like over 30 price to book, and Google is at 8. Facebook is at 6, Amazon is at 12 times. You need to get to the banks to get closer to like 1 times a price to book. And I'm not going to be invited ever again, but I'm going to say it. Accounting is mostly fiction. And obviously that's the wrong audience for that, but I'll say it just because almost everything you read is fiction. The cash on the balance sheet, A, is owed, B, has Forex, C, you have paid out dividends, interest, etc. in the 45 days or whatever it is since it was reported, right? Depreciation is fiction. It's probably accurate for cars and computers or like UPS trucks and so on. But you walk around Manhattan. If you'll be institutionalized if you walk into a 100-year-old building and you want to buy it for zero because it's depreciated, right? You'll be left out of the room. So when you think about those GAAP limitations, and it really, the standards really do a bad job at capturing intangible values, right?
I'm glad you bring this up because I've been wondering, how do you account for certain things that we hear about in the news? So like when Nike signs a celebrity endorser, how do you value something like that? I mean, there's probably a contract value to sign somebody like Michael Jordan, but then what's the value of what they can deliver in terms of sales?
Exactly. So nobody knows. And specifically, even endorsement contracts, which are liabilities, are not on the balance sheet. So if specifically, talking about Nike, if you read their latest balance sheet, there is a line that says commitments and contingencies. You go and look at that in the footnotes. Their endorsement liability is over $8 billion. And for scale, their EBITDA last year was 7.7. So it's a 1/3 of EBITDA leverage that you're adding by having that endorsement contract. So should it be part of the enterprise value somehow? Well, maybe it should be. Should it be on the balance sheet? Well, yes, stuff like this happens, right? If you remember, Steve, retailers had to bring in the leases on their balance sheet. So they had the right of use as an asset, and then you had the liability. So these sort of things are simply not very properly accounted for. Like advertising is expensed. Now, should it be? Well, I don't know. R&D is expensive unless you buy it. Then it will scrap some value. So I think these are necessary assumptions, but they lead to these sort of really gross distortions.
And this episode would be grossly distorted if we didn't take a quick break to hear from our sponsor. We will be right back with Nick Mazing in just a moment.
Today's episode of Off the Books is brought to you by Workiva. Author Stephen King is famous for lots of novels, including It, Pet Sematary, The Shining, and that one you left at an airport Qdoba but can't remember the name of, but it was good. What's interesting about Stephen King is lots of things, and also that he writes all his novels by hand, like writes them out, pen and paper, carpal tunnel, the whole thing. To me, that's insane. For anyone that's ever used a computer, that's completely bonkers. We have made advances past that already. Yet, Stephen King keeps doing his King thing that way. Dear listener, you are not Stephen King, I am sorry to tell you. You have deadlines and audit committees and bosses and outside auditors and the SEC breathing down your neck. That's why it's time to take your accounting and compliance work out of the pen and pencil dark ages of Microsoft Word and Excel and into today. Here's Workiva. Automate the useless stuff and spend more time on what's important. No more pencils down. Link critical data from point to point and keep working right up until they tell you not to anymore. Plus, work anywhere you need to be. Home, the office, or room 237 at the Overlook Hotel. After all work and no play makes you a dull person. Yes, Workiva, it just makes sense. Come play with us forever and ever and ever. Check out workiva.com/podcast to learn more and to see a demo. That's workiva.com/podcast.
We are back with Nick Mazing, who just explained to Steve why accounting is fiction.
Dun dun dun. Well, I just need to point out that my self-esteem is not compromised the least bit of this conversation. A couple of weeks ago they were slamming Ohio State. Today, accounting is fiction. Next week we're going to be talking about Pepsi. It's okay. I can hang with all of it. Here's the thing that I keep thinking of as an accountant is that fair value, which is really what we're talking about. What is the price at which this asset can be sold? Fair value is generally a concept that has been shunned by accounting strictly because of how difficult it is to determine and how differences in comparability from one period to the other can make it very hard to find utility in the financial statements. And I bring that up to ask, would you agree, though, that there's a benefit to say that, well, even if we don't think that accounting today gives us current fair value, because we know the basis upon which it was calculated, so historical cost, users of that information can then make their own assumptions in order to determine what they think the value is. That's kind of the first question I would ask. And maybe the second, if you'll indulge me for a second, is that when you look at price to book, my understanding is always that as an investor, I'm investing because of what I foresee as the future potential. So I start with what today's value is, and then I think, hey, I think this is going to perform well. It's going to go up. So when you start to see things Again, I said a price to book difference as high as 5 to 1. 5 to 1 is the average, as you just shared, sometimes as high as 38. Well, then I guess what I'm thinking as an investor is, hey, I think there's actually a 38 times upside, let's just call it. I'm not saying that very well. How do you sort of reconcile those 2 points that I'm making, Nick, with, I think, a very valid point that you're making overall is that, hey, maybe this information isn't as useful as accountants think that it is?
I think investors live with, and have to live with, the assumptions that are native to accrual accounting, right? So you have to make a lot of assumptions regarding a lot of things. Example, very high profile example is General Electric, right? They had long-term care liabilities, long-term care insurance liabilities that there was a whistleblower case with the Madoff guy, Markopoulos, right? And it turned out that they were under-reserving exactly for this sort of long-term thing. So is it going to matter eventually? Well, maybe it will, maybe it won't. But the assumptions are one thing. Now, what do sophisticated investors do to account for that delta is a very different thing. So if you look at kind of broadly intangibles, patents, culture, network effects, brand we already discussed, and so on. You look at culture, you have sophisticated investors that are mining Glassdoor reviews for different dimensions of culture, like teamwork or results orientation or some of the others. And they do maps and they try to map out, okay, these are relevant measurements of culture, and not necessarily assigning a dollar value, right? Brand valuation has been around forever, right? Every year there is like Interrepublic and Kantar, they put out the most valuable brands in the world. They have certain methodologies. You could add that to the book value, probably should, right? So people have to, meaning investors, have to account for all those things that GAAP doesn't account for whatever reason. And it is happening. You see people that are, and you see it in the market, companies that have network effects, right? Like Amazon, right? Why are you buying on Amazon? Because everybody's selling on Amazon. Why is everybody selling on Amazon? Because everybody's buying on Amazon, right? Facebook, why are you on Facebook? Well, everybody's on Facebook, and so on, right? That's or WhatsApp, Instagram, etc. Those things are completely intangible, right? Like how do you account for network effect?
It's a very, very interesting question. And an axiom that I would use in financial reporting actually is that often, in fact, most of the time, consistency is better than accuracy. And maybe where we land here, Nick, is that perhaps the accounting profession sees so much risk in starting to monkey and change, mix up some of these things in order to not jeopardize the consistency that, while maybe inelegant, investors and others have been able to sort of deal with to still make, somewhat rational investing decisions.
Non-GAAP is used by companies themselves pretty widely. Like, so if you look at something like fairness opinion, right? In an M&A transaction, very often there is a document that has a fairness opinion, an independent bank that says, hey, this is a fair transaction. What do they use? They use EV to EBITDA. EBITDA, if you have read any footnote, EBITDA is not a GAAP measure. Obviously, sometimes it gets a little bit more in the sausage territory with adjusted EBITDA and so on, but it is not a GAAP measurement. You look at the entire SaaS sector. It is not valued at any GAAP metric. They're valued at ARR, annual recurring revenue, at whatever, the time period. Their investors are looking at DBNR, dollar-based net retention. They're looking at churn, customer lifetime value, and so on. Oil and gas, PV10. What is PV10? Well, go and read a 10K, but it's a measurement of reserves. It says non-GAAP, right? And yet people care about it really, really deeply. You look at biotechs. Hundreds of biotechs that are burning cash, zero revenue, and yet some are worth, hundreds to billions of dollars, right? What's going on? Well, the accounting value is completely irrelevant because people are looking, okay, what are the odds of this specific drug progressing through, the 3 phases? What is the potential end market? Can we discount that back, right? And it's a bunch of PhDs doing that. So, I wouldn't want to compete with them, but it's, these are all examples where non-GAAP really drives what is happening, whether it's a board approval of a deal or investors looking at biotech stocks that are completely, on an accounting basis, they're just, there is burning cash and there's nothing there, because like each of these things you can dig much deeper, and I think it's fun to argue with people that their profession is fiction.
Well, again, my self-esteem is not compromised in the least. But what is also fun is our closing question of the day.
Sure. Well, we were talking a little bit about book value. I want to know, what is the asset you value the most that is worth way more than its book value?
I mean, children are a huge long-term liability, but it's certainly something that I value probably the most in the world.
Well, you stole my answer, Nick. I wholeheartedly agree. And if I had to choose something different, I would say that what I value far beyond its book value is the Chuck Norris calendar that hangs just over my right shoulder. This is an audio podcast. Our listeners can't see it. I bought it as a joke a year ago. I've gotten so many comments about it. It's got some funny sayings on it about Chuck Norris. I laugh every time I see it. It's worth way more to me than the $13 that I spent on it, and I'm excited to do it again next year. Catherine, how about you?
I can't beat either of those answers. Those are really good. I was going to say paintings by my grandpa.
Hey,
Nice.
That's a great one.
Got some in my home, so.
That's wonderful. Catherine, that was a good one. It's always good to catch up with Nick Nazing. Did we learn anything?
I learned that if I want to tick you off, I should say accounting is fiction. But I think I also learned a little bit about how accountants have to factor in not just hard numbers, but some things that can't always be quantified, like the value of a celebrity endorsement.
Well, you're exactly right. As I said, for many years in my career, accounting is not black and white. There's a whole lot of gray, and I think Nick actually just highlighted perhaps maybe more gray areas that perhaps weren't even on our radar. And with my accounting self-esteem fully intact, we thank you, dear listener, for joining us today. I'm Steve Soder, that was Catherine Tsai, and this has been Off the Books, presented by Workiva. Please subscribe, leave a podcast review, tell your buddies if you like the show, and feel free to drop us a line at offthebooks@workiva.com. Surf's up, and we'll see you on the next wave.